Welcome to this week's Money Roundup, where we'll be discussing oil, Greece and Heathrow Airport.
We start by rolling out the barrel and looking at oil. The Organisation of the Petroleum Exporting Countries, OPEC, gathered on the 22nd of June to discuss future levels of oil production.
A closer relationship between OPEC and non-OPEC producers, including Russia, has seen the price of oil rise well above $71 per barrel in recent months.
Having suffered the effects of a squeeze in production earlier in the year, the US and other key oil importers have started to pressure oil producers into increasing supply by suggesting price caps and other alternatives to stop prices rising.
Higher oil prices lead to lower disposable incomes, which means domestic consumers then have less money to spend on other products, which slows economic growth.
In order to reduce the oil price and avoid potentially damaging price caps, which could put a ceiling on profits, OPEC and its allies have agreed to ramp up production to 1 million barrels a day, with an aim to keep price, supply and demand on a broadly even keel.
In the aftermath of the financial crisis, Greece, like a number of other European countries, emerged in a state of economic instability with a budget deficit equal to 12.9% of its gross domestic product.
9 years and 3 bailout payments later, Greece finally has been lifted from the depths of austerity. European finance ministers have agreed an element of debt relief being granted the recovering nation. The Greek crisis ends here, according to Pierre Moscovici, the EU's Economics Affairs Commissioner.
A cash buffer of €24 billion can cover Greece's payback obligations for the next couple of years. However, with interest rates on 10-year Greek government bonds remaining above 4%, investors are not fully convinced that the country can yet service its debt in the medium term. Greece has the continent's biggest debt burden as a proportion of GDP at a staggering 177%. In order to meet its new targets, it will have to maintain a budget surplus for the next 50 years. And with unemployment above 20%, the country is still not out of the woods despite new measures.
To remain compliant, Greece will be forced to maintain a budget surplus of 3.5% until 2022, reducing to 2.2% until 2060. These strictures are imposed to improve the likelihood that the €200 billion owed to other Eurozone governments is fully repaid.
This past week, after several years of discussion, the House of Commons voted in favour of plans for a third runway at London Heathrow. This privately funded expansion will cost between £14 billion and £18 billion, with a construction time of 7 to 8 years.
The much-needed expansion will allow Heathrow to increase annual capacity of the airport from 78 million passengers per year to 135 million and create 114,000 additional jobs in the economy by 2030, further reducing UK unemployment.
In terms of scale, the UK aviation network is the third largest in the world, contributing £22 billion annually to GDP and responsible for over 1 million jobs. According to data from the Civil Aviation Authority, 2.2 million flights took off from the UK last year, carrying 285 million passengers, with London Heathrow handling 27.4% of those. Globally, Heathrow is the 7th largest airport in the world.
Despite these impressive numbers, Heathrow has been at capacity for the last 10 years. In another 10 years, a third runway should help to improve this situation.
Thanks for watching. See you next week for another Money Roundup.
And don't forget, it's coming home.